What's good, everybody? This is Noah from iCharts. Welcome back for another video. If this is your first time here, make sure you subscribe and first watch the previous videos because it all adds up better if you have watched the first few videos, right? So today's topic is gonna be the trend. We're gonna talk about what the trend means when it comes to trading. Uh, from the from the from the very previous video, Kenny talked about candlesticks, what candlesticks mean, uh, how they form, what they basically what they mean, what candlesticks mean to the trader, right? Like what they add up to and everything. So when candlesticks do form, like each one after the other, they do tend to make patterns, and those patterns, they end up being a trend, they end up forming a trend. So a trend just simply means that like the simply means consecutive candlesticks that do form a pattern, and a pattern that's directed towards a specific direction. For example, if the markets are going up, that's a trend. If the markets are going down, they make a trend as well. So I'll first start with what types of market conditions exist when it comes to the financial markets. Uh, Number one is gonna be obviously trending markets and ranging markets. So best case scenario, you wanna be trading within trending markets, because ranging markets are pretty hectic, and they don't really have a direction. And if you do not have a direction while you're trading, there is no point, because you can only buy and sell, and buying simply means you're taking the markets higher, selling just simply means you're taking the markets lower. So yeah, so you preferably want to be uh in a trending market. So we'll go ahead and look at like what a trend consists of. So a trend simply consists of one, an impulsive move, then a retracement, right? So it's like if first price first moves higher, right? Moves higher or lower, any of the two, moves higher, then lower, then higher, then lower again, then higher, then lower again, then higher, etc. So this is what we call the impulsive move. This is the retracement. Impulsive move, retracement, impulsive move, retracement, right? So that's all these when a trend forms. That's all there is to a trend. So I'll show you examples of what an impulsive move and a retracement, how they compare, right? So for example, on this pair USD CAD, so this is the US dollar versus the Canadian dollar. So you'll see that the price here is in an impulsive move. Retracement, impulsive move. Retracement, impulsive move. Retracement, bit of a range here, impulsive move, retracement, impulsive move, retracement, uh, impulsive move as well. So yeah, and then it keeps doing that over and over again, right? So but I'll show you what a range looks like, and I've showed you what a trending market looks like, and what a range. I'm going to show you what a range looks like so that you know what is not a trend, right? So so all this here is a range, right? Because the market does not have any given direction. The market is uh within two within like basically between a range. It's like it's within a range. It's within a top and a bottom. It's within a roof and a floor, right? The market is not being able to break those two levels, right? To break the floor, or break the ceiling, right? So you gotta be mindful of what of what market conditions you're trading, right? You wanna be in an uptrend, not in a you wanna be in a trending market and not in a ranging market, because a ranging market, as you've seen, does not have any direction. You might be able to sell from the bottom to the top, but it's not really a reliable way to trade, right? It's better to trade when when the markets are doing something that's more predictable than a range, because a range is not pretty much is not it's highly unpredictable, because it could break at any point and you do not know, and it could also do something that's called a fake out, right? It could pretend that it's going one direction and then reverse back and go back to the other direction, as it did here, right? You can see that it pretended to break this level, right, by doing this, but then it went back up. So you gotta be mindful of that. That's why it's way better to follow to follow the trend, right? So uh, when we talk about trend, when we talk about a trend, there are two types of trends. There is an uptrend and then there is a downtrend. So I'll what I've just showed you what I've just showed you a few moments ago was an uptrend. So I'll just repeat that. So here is an impulsive move, a retracement, impulsive move, retracement, impulsive move, retracement, impulsive move, retracement, etc. Right? Markets repeat themselves over and over again, right? So for for an uptrend, the markets do form something called higher highs and higher lows, right? So they simply mean what those words mean, right? A higher high and a higher low, right? Let's use a different color. Let's use pink, right? Higher high, higher high, higher high, higher high, higher high, right? So what this means is simply is simply a moment, okay. It's simply that this okay this this is just a low, right? This is where the market starts from. This is a low, casual low, and then here is a higher high, right? So compared to the last high, which is this, which is this, right? It's a new higher high, right? The market reached a new level compared to the last high that it did, right? And then when it does have a retracement, when it does have a retracement, it makes a it makes a higher low. So it's like the previous low is here, and then this is a higher low. So it's higher than the previous low, right? And then after the retracement, it makes the impulsive move and makes a higher high. So the higher high simply means that price is higher than the previous high, which is this, right? So I'll write the texts. So higher high as well as higher low, right? Higher low, higher low, higher low, higher high, higher high, higher high. So uh, here the price has made a higher high. So it means that this high is higher than this high, right? And then makes a retracement. The retracement now becomes the new higher low, right? So it's like this low is higher than the previous low, so it becomes a higher low, and then makes an impulsive move, and then this high is deemed to be a higher high because this high is higher than this high, so it's a higher high, right? So it's higher. This high is higher than the previous high, right? And then higher low because it's higher than this low, higher high because it's higher than this high, higher low because it's higher than this low, right? And the market keeps doing that, right, over and over again, right? Now let's look at on the flip side when it's a downtrend, right? When the market is going down, right, instead of going up, right? All right, here's a downtrend. Here's a downtrend. So here you see impulsive move, retracement, impulsive move, retracement, impulsive move, right? Very simple, very clear, right? So 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 it's basically the same thing, but on the flip side, right? So but the terms are gonna be kind of different, right? Terms are gonna be kind of different because technically they're different, right? So uh, we're gonna call this a high, right? And then this a low, right? So it's like wait, very high, very high, low, right? So this is the starting point of the market. It's a high, right? The market makes an impulsive move to the downside. It makes a lower low, right? Because you're shooting for lows. If you're selling, you're shooting for lows. The market makes a retracement, lower high, right? So because this high is lower than this high, right? And makes another impulsive move, a lower high, right? The low no, it makes an impulsive move, shoots for a lower low. And this low is lower than this low, right? So that's simply what it means. So we call this a lower low only because it's lower than the previous low. And the lower high, when the market makes a retracement, we call this a lower high only because this high is lower than this high, right? And price shoots for a lower high. No, price shoots for a lower low again, right? For a lower low over here, right? And you call this low a lower low only because it's lower than this low, right? And the market transitions again into, and here as well you can see that this is a range, right? So you can see that the market is in a range over here, right? So it's not breaking the bottom, it's not breaking the top, right? So you want to stay away from these markets until it switches back into a like a determined trend where you can identify a lower low, lower where you can identify higher highs, higher lows, lower highs, right? So for example, I wanna show you how the market transitions into like a trend from a range, right? Because that's kind of confusing. You gotta know like how that happens so that you're able to like benefit from the market, right? First of all, okay, here you see that the market is not doing much, right? Like all through here, the market is not doing much, right? The market is not doing much. It's simply going up to the top, back to the bottom, up, bottom, up, bottom. That's bottom top. That's all it's doing, right? So uh but you see that when it touches here, it does something different, right? Here there is a high, right? There's just like a high in the middle of the range, right? But guess what? It gets broken, right? It gets broken over here, and price forms a higher high, right? When price forms a higher high, let me draw a better line. Uh, Here this high gets broken, right? This high gets broken by an impulsive move of like an uptrend impulsive move, right? Impulsive move, and price breaks above, and we do form a higher high. So now we identify that price is most likely going to keep going up. Is going to the price is most likely going to keep going up. To keep price is most likely going to go higher, to keep going higher, right? Because it formed a higher high, and that's structure. That's that's like that's what determines an uptrend, right? Higher highs and higher lows, right? And then when it makes the retracement, it forms what? A higher low, because it's higher than the previous low, right? So this low and this low, if you compare them, this one is higher, so we call this a higher low. And price does that after retracement. When it does that, price makes another impulsive move, makes a new higher high, right? It's higher than this high, right? As well as these highs over here, right? These more like more imposing, let's say, right? More imposing, let's say, because they're higher basically, right? They're pretty much higher, right? But price breaks them nonetheless, right? Price breaks them, makes higher high, and this higher high is bigger than is higher than this high, this previous high, as well as these highs, right? So this is a very important high. Price breaks above, makes a retracement, and then forms a new higher low, because this high is no, this low is higher than this low, right? So it's a higher low, right? Simple as that. That's all it is when it comes to when the markets when price transitions from a range to a trend. So you do the same thing whenever it comes to a downtrend. If let's say the markets were flipped, right? So you see it's the same thing. This is a high, markets makes a low, and this becomes a lower low, because this low is lower than these lows, right? Price makes has a retracement, makes a lower high, shoots down for a new lower low, because this low is lower than this. Price makes a retracement, and forms a lower high, because this high is lower than this. Then shoots again for a lower low, because this low is lower than this. So it's pretty very simple, not easy but very simple, right? And clear, right? So next up, we're gonna look at we're simply gonna look at the strength of a trend, right? So like how to identify like how strong is this trend, how weak is this trend, and so on, right? So uh like to put it very simply, so to make it very simple, you can uh, you can tell the strength of a trend by like the size of the candles, right? And that we would call that momentum, right? Like like how big are the candles in that direction, and like are they interrupted by the opposite candles, right? If let's say the market is going down, right, within this impulsive move, are the candles like big enough, and are they interrupted by uh by green candles? Here, red candles simply mean that the market is going down. Green candles, the markets are going up. So are the red candles interrupted by the the green candles? So bearish candles, bearish candles, bullish candles. So so are the markets are the are the bearish candles interrupted by the bullish candles? No, for this impulsive move? No, they're not. So this is a strong trend. So yeah, that's one way to identify how strong a trend is, right? The other way to identify how strong a trend is by like is by determining how deep the retracements are, right? So, and one way to do that is to use the Fibonacci levels, right? So Fibonacci retracement levels. So basically, all what they mean is that right. Let's take see this entire move, this entire impulsive move as a percentage, and then see the retracement as a percentage of the impulsive move, right? So it's like look at it, you basically fraction the what the like you fraction the markets, right? You take the size of this against this size, right? You're not supposed to do that like mathematically, but that's the principle of it. So just for you to get the gist of it, right? So for Fibonacci levels, you basically connect the swing lows, the swing highs to the swing lows, and the swing lows to the swing highs, right? Depending on what trend you're in. So, for example, if you're in a downtrend, you connect the swing highs to the swing lows, right? So it's basically you connect lower highs to lower lows, right? If you're in an uptrend, okay, let me just write it down. If you're in a downtrend, right? If you're in a downtrend, you connect lower highs to lower lows, right? If you're in an uptrend, you connect higher highs. No, you connect higher lows to higher highs, right? So it's as simple as that. It doesn't get any simpler, right? So let's look at what the Fibonacci levels are. So you simply connect this this lower high to the next lower low, right, which is here, right? And for my settings, you can just screenshot this, pause the video, and take a screenshot, right? So basically, so you connect the lower high to the lower low, and whenever you do that, you see the percentage over it, like to the side, right? So you see that if price only retraces to this level, it's price has only retraced 23% of the impulsive move, right? If you retrace it to 38.2, price has retraced 38.2% of the entire move. If price retraces to the 50%, it has retraced like 50% of the impulsive move, like half of the move. If it retraces to the 61.8%, price has retraced to has retraced only has retraced up to 61.8% of the impulsive move. And the reason why there are these specific numbers, you simply gotta ask who Fibonacci is. So simply go to Google Fibonacci, I believe is Italian. Yeah, Fibonacci numbers, Leonardo Fibonacci. Yeah, this is him. He's the creator of the Fibonacci sequences and numbers and all that comes with it. And people somehow were able to turn this into a trading tool, right? So simply use these numbers and you'll be okay, right? So now that we've seen how to identify the strength of the trend, let's look at how to benefit from trends, basically, right? So uh, to be able to benefit from trends, you simply like take the trades you simply take the trades. But wait, let me first touch on the on the flip side if it's an uptrend, right? Because let's look at okay, right here, right? So here we do see a clear uptrend where price is making higher highs, higher lows, higher highs, higher lows, higher highs. Here price has retraced 100% of the impulsive move, right? So it simply becomes a nickel low, right? A nickel low, higher high, higher low, higher high, right? etc, right? So on uptrends you simply connect higher lows to higher highs, right? Sorry, over here, yeah, over here. And you want to make sure to either connect okay to either connect the very week to week or body to body, right? If you're going to connect the fibs, so you don't want it to be like right in the middle of the move like this, because it doesn't make sense. It has to be at the very end of the week or at the very start of the week, right? Like this. So you have to be really like meticulous in how you 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 draw your fibs, right? Because there are specific numbers for a reason, right? So for example, at this level, for this impulsive move, price retraced like about 23% 0.6, close to 38%, 38.2% of the impulsive move, right? The price shot up for an impulsive move, right? But for this impulsive move, right? Price retraced 100% of the entire move. Like as you can see here, the 100% line, price got to that level. So this shows you a weak trend, right? So basically, the deeper the retracement, right, the deeper price retraces, like on these levels, on these percentages, the weaker the trend is, the weaker the trend is going to be, right? So for example, here after this impulsive move, right, price retraced up to 61.8. So so here the trend was gaining more, like gaining back strength after it had retraced to 100%, right? And you can definitely see that it did have strength because the way it pushed really, like for a really long time, right? For over how many pips? Around 100 and something pips, 110, 105 pips, right? So yeah, so now let's look at how to benefit from trends, right? So if you do take trades, right, and you want to benefit from a trend, as like you want to be trading with a trend, so you do take you take your entries at the retracement. Whenever price retraces, you do enter, right? You enter as price retraces, right? So for example, price is shooting up, comes back lower, shooting up, comes back lower, shooting up, comes back lower, shooting up. So you want to enter at the higher lows, right? If it's an uptrend. If it's an uptrend, if it's an uptrend, you want to enter at the higher lows. This is where you want to have your entries, right? At the higher lows, right? If it's a downtrend, on the flip side, you want to enter at lower highs. Every time after retracement, that's where you look for entries in a trending market. So for example, here after this retracement, you could look for an entry after price has retraced, right? Impulsive move, retracement. You look for your entries around this area, right? This is where you look for entries to take the markets higher. Since it's an uptrend, you want to take buys. So that's all there is to it on how to benefit from trends. And you do the same thing if it's a downtrend. Uh, okay, here's one. Price is moving lower, lower low, lower high, lower low, etc. So as you can see, this low is lower than this, so it's definitely a downtrend, and this high is lower than this, so it's a lower high, so this is definitely a downtrend. So to be able to benefit from, let's say, this move, you would have to enter around this area, right, at the lower high. Text at the lower high. At the lower high here, right, at this area, to be able to benefit from this move, right? And as well as pull out, draw your fibs to be like, okay, this move retraced this percentage and this percentage, to be able to know what to expect from the market. Because if price retraces all the way to 100%, you don't want to expect much from it, because it just shows you that the trend is weak, right? So, but here price is only retraced to 61.8%, which is like an average, which is like the average, as like that's where usually price retraces to it. That's where usually the markets retrace to, right? Because the markets usually have a balance between between moves between moves high between higher moves and lower moves, like between how the markets move higher or lower, right? The markets do have kind of have a balance when it comes to that, right? So yeah, 61.8, price moves lower, could have made a lot of money from this move, right? So yeah, that's pretty much how to benefit from uh, from trends. And one last thing I want to talk about is like how the markets are fractal. Like the markets are fractal, right? That means that, okay, let's just look up the fractal link, right? Fractal means is a curve or geometric figure, each part of which has the same statistical character as the whole. Fractals are useful in modeling structures such as eroded coastlines or snowflakes, you see, in which similar patterns require a progressively smaller scale, right? Like keep this in mind, right? In which similar patterns recur at progressively smaller scales, right? So same thing with the markets. The markets may seem as if here may seem as if they're simply going down, but if you go to a lower time from like the 1 hour, they're fractal, right? There are downtrends, there are uptrends all throughout here, because this is the daily time frame, right? This is the daily time frame. So these are pretty large scale. So if you go to a lower scale, like it will have properties of an uptrend, it will have properties of a downtrend if let's say it's an uptrend, for example, all the way like through here, right? Through here, the market is not only going up, the market is not only taking one direction if you go to the lower scale. Here it may seem as if it's only like going up, retracement, impulsive move, retracement, right? But that's not the case on the lower time frames. And let's just look at that. So let's look at that, mark that off, right? So first of all, this is a 4-hour time frame, so it's kind of similar to the daily time frame. It's closer to the daily time frame than the 1 hour is closer to the daily time frame, right? But you can already see that here price is not only going down, so it goes down, up, down, up. So it kind of has the properties of a downtrend, right? Here, right? Just here on this retracement, right? It has the properties of a downtrend regardless of the fact that it's in an uptrend if you go to a daily time frame, right? Now if you go to the lower time frame like the 1 hour, now also has properties of it has like it's clearer that it could have properties of a downtrend, right? And we can see that here, right? Price moves lower, a lower high, lower low, lower high, and then it forms an equal low, right? So you do see that price is making is having like is forming a downtrend within an uptrend. So it's like the price has trends within trends, right? So as long as it's a smaller trend within a larger trend, it still makes sense. Do not get confused about that. Do not get frustrated whenever you see something like this within an uptrend, and whenever you see a move like this. So do understand that the markets are fractal, right? They do have smaller trends on lower scales, on lower time frames, and they have big trends on higher time frames, and they do have trends within trends on yeah, they do have trends within trends, like they have higher time frame trends, lower time frame trends within higher time frame trends. Like to put it in perspective, this is a 1 hour downtrend, but if you go to the daily time frame, this only looks like a retracement, right? So you gotta keep that in mind whenever you meet that in the markets. Do not get confused, do not get frustrated, as it does happen quite often, right? So yeah, and that's pretty much it. So thank you for tuning in, and yeah, make sure to like rewatch if you're confused. Uh, come back to the video, watch over and over again until you get it. I mean, it's a long video, 40 minutes, but that's how much it takes. That's how much time it takes to dumb down the knowledge that someone to dumb down the knowledge a person acquires over a long period of time, over like a year plus, right? So yeah, make sure to comment, like, subscribe, and share as well, so that we can get this back, not just like get it by ourselves. Like we want to put on as many people as possible, and yeah. So yeah, so tune in, and thanks for if you watched all the way through here. Thanks, really appreciate that, and yeah, see you in the next video.